Good morning and welcome again to this month's Oakcrest Insight. Last month I shared our perspective for 2022, but I really started focusing on volatility increasing. January saw just this for investors and the stock market. We haven't seen almost any downside in the markets since March of 2020 when COVID hit. But January saw the S&P 500 drop about 10% in less than a month from highs earlier in the year. Now, after an extended period of strong performance in the markets, we sometimes forget price swings, market corrections like January, are just part of normal fluctuations of the market and being investors. So put in perspective, the S&P 500 has averaged almost 10% the last 15 years. It's pretty amazing to think about, right? Think of all the things that have happened in our economy the last 15 years and still average 10% over those 15 years. I remind investors of this as we go through ups and we go through downs in the market, that it's not just a straight line up. Now to January. The most significant contributor to January's market decrease was the Federal Reserve's shift from a slow increase now to rising interest rates and tightening much quicker than we expected. Last October, the markets were expecting 1 or 2 25 basis point rate hikes in 2022. Now the Fed is going to start increasing rates starting in March, and the markets are forecasting up to 5 rate hikes this year. So what drove this shift? Inflation. In 2021, the Fed was predicting inflation to start taming off and being transitory. The Fed's projections and forecasts, like many other projections on inflation, were incorrect, as instead of easing, inflation picked up steam the last quarter of 2021. Now, to slow down inflation, the Fed has to raise rates quicker than expected, and really the uncertainty of how many rate hikes are going to happen here in 2022 is the main driver of January's downturn. Now, this change of sudden behavior caught investors off guard, right? We weren't expecting it. The Fed changed real quick. It caused a lot of uncertainty. Inflation and interest rates, unfortunately, weren't the only factors that happened in January. Supply chain issues continue to persist. COVID cases surged towards the end of the year and into January with Omicron. And lastly, we have geopolitical tensions as Russia continues to threaten to invade Ukraine. Now, this is really significant as Russia supplies nearly a third of Europe's national gas, and it moves through Ukraine to get there. That's a lot happening all at one time in 1 month, right? So you always hear me talk that the markets forecast in advance, and they hate uncertainty. And last month, what do we have? We had a lot of uncertainties with multiple headlines hitting at one time. So where's all the optimism in all this uncertainty, and what are our thoughts? Well, the markets are planning worst case scenario with uncertainty, but Bloomberg, since the beginning of this year, has started raising their earnings expectations for the S&P 500. Now, this is important as the Fed hiking rates has incorporated more risk to the markets. But the fundamentals of what drives the markets remains strong: corporate earnings. So at the end of December, fourth quarter profits were expected to be about 21%. But now here as of last Friday, fourth quarter profits at companies in the S&P 500 were expected to increase more than 24%. So short term, there's a lot of uncertainties, but expectations are for consumers to continue spending and employment to remain low. This is why short term we have uncertainties, but the underlying fundamentals of why the markets increase remains strong. Now, we're obviously going to continue monitoring all of this and these factors and how they affect your retirement. As always, please give us a call if you're worried or concerned about anything, as that's what we're here for, right? We're here to help you stick to your financial plan and not panic. We look forward to seeing you next month on Oakcrest Insight.